everybody's got to know themselves and back into what you want.
Yep.
And
Bingo.
then figure
That is
out
great.
what is going to get you there. So if you want $1 billion company, you can't go do 175 units. That's never going to happen. Even if you've got a staff of 2,000 people, you're going to have tens of thousands in units. You're going to have to be in different asset classes, different countries. But if you want to just live comfortably, you don't need that. You could have 8 rentals.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik, and with me, as always, is John Cohen. John, how you doing?
I'm doing good. It's Halloween.
Yeah.
And my daughter's first Halloween, so it's going to be it's interesting. I've been stalking kids on our Nest doorbell. And
I don't think you're supposed to actually talk about that.
I know you're definitely not, but my wife lives in an apartment building her whole life, so this is the first time in a house. So I texted her, and I was
I didn't realize that.
Yeah, I texted her, and I was like, "You're doing a good job," and she's like, "This is the best. This is so I've never done it." So she was really happy. I did get out of trick or treating because it's raining and it's not nice out, and my daughter's 8 months old, so. I'm doing great.
There you go. Yeah, weather's definitely not great for it, so hope you don't have to do it later.
Yeah, no, she's young, so the rainy day was the ultimate trick-or-treat killing, so
there you go.
She's dressed like a little unicorn, though, so
very nice.
She
very
did dress
as
up.
well. We'll have to plug it in the video.
There you go.
All right, but just jumping right into it, we've had a busy week, so we haven't done one in a while, but happy to get back on the horn here. Our guest today actually did his YouTube show about, I don't know, maybe week and a half ago. It went really well. Figured I'd have him on. I think he's got a little bit of a different story from a lot of the other people we've had on and some more experience than a lot of the other people. So I think he'll provide some good insight, and a lot of the stuff we talk about as well, I think will be good. With that said, Mike, thanks for coming on the show.
Thanks, Chris. Thanks for having me. Yeah, our show was a lot of fun. You can go back and look at the comments, and people were very impressed with what you had, and they liked the discussion, right? We asked honest questions and gave honest answers. So it was a lot of fun, I thought.
Yeah, me too. And that's what we're all about. That's what we're trying to do here. So I was very happy it went as well as we did. I know we didn't really know each other prior to, and that was kind of our introduction to each other as well as kind of recording at the same time. But I was very surprised at how well it went. I was like, fuck, I got to get this guy on. So very happy you could join us.
Absolutely.
Why don't you, tell anybody who's listening, if anybody's actually listening, who you are, what you're about, how you got into real estate, and kind of your background.
Yeah. So my story in kind of a nutshell is I probably, like a lot of your listeners, I was a W-2 employee. I worked in sales. My life changed on my 30th birthday, which was almost 2 decades ago. So that age, give it my rough age when I read Rich Dad, Poor Dad. Mm-hmm. I realized that, having a decent income, but no real passive income meant that I would have to keep doing what I was doing forever. And I was being idiot spending all of my money, right? The fact that I had a good commission check or a good year or whatever didn't mean anything because I had nothing to show for it at the end of the year when I, kind of went and saw my accountant. So that changed, right? There's stories about this little condo in Hawaii and a condo in, I think her condo was in Portland or wherever it was, sort of set me on this one rental at a time strategy. I didn't have any big plans. I just knew if I got to four boring single family homes, 3-bedroom, 2 baths, 2-car garage, that my future would be better. And, the story goes, you get to 4, and then you get to the 5th one. And, I started pre-crash, which will be fun to talk about because, I can't say I saw it coming. I just knew that I wasn't going to be able to buy the 9th property. Mm-hmm. So we did a bunch of 1031 exchanges and took all of our equity and put it in small apartment buildings and completed that, completed the last one probably right at the peak. Mm-hmm. So it rolls over, everything is worth less, but the houses get crushed.
Right.
And we're just sitting in apartment buildings. So we're fine. Then we go on a shopping spree as stuff gets cheaper. We buy everything we can, from single family homes to 18-unit apartment buildings. Everything is my wife and I. We don't have any partnerships or syndications or anything. But we ultimately build a portfolio of 175 rental doors. And the wife retires about 5 years ago, and I retired about 2 years ago, all because of one rental at a time. Real estate really can get you there, can replace a 6-figure income, or in our case, 2 6-figure incomes. But it takes time. You got to be conservative. You can't be silly or stupid. You can't get over leveraged. You can't get too cocky because the market will kick you in the nuts. And, that's kind of my story.
I love all of that. I don't know. Everything you talk about is everything I think about, but except you've done it for the past 10, 15 years. So that's where, we were having a conversation about all the stuff you just touched on, like taking it slowly, compounding on top of each other, replacing income, not over leveraging. And then the fact that you have the experience through that crash, I think is just invaluable for probably anybody you speak to, especially, our age. John's a little bit older than I am, 5, 6 years older. So he was like just entering the workforce as it started. I was in high school. So I lived through it, but not really.
You really didn't have any money on the line, right?
I didn't have any money, so can't have anything on the line. But yeah, I think it's great. So, talk a little bit more. Well, let's start closer to the beginning.
Okay.
Right? You read the book, you got involved. I think a lot of people get frustrated with the time it takes, and especially that first or that third or that fourth rental, that it's probably cash flows a couple $100 a month, if that. Take me through that and what it was like, and how you got through that period.
Yeah, that's a great question. And I've only come to appreciate it after I've retired, because that tells you how much of an idiot I was, right? I was working 60 to 70 hours a week, raising a daughter, and finding a way, to buy a rental property, once, twice, 3 times a year. So like I didn't have a chance to look up, right? So, but now that I look back on it, I really tell people there's a phase 1 to all of this. It doesn't matter how much money you have, whether you have a little or a lot. We started with 40 grand. I mean, some people listening to that think 40 grand's a lot. Mm-hmm. Most people listening to this probably like, I got that. What's he talking about? Right. So, I mean, I can't be anything but that was our story. So where I go with this phase 1 is you have to get in it. You have to start, right? 0 to 1 is the hardest. Mm-hmm. 1 to 2 is the next hardest. And by the time you're at your 4th, it's like buying shoes, right? It really is that simple, right? But yeah, going from 0 to 1 is hard. And then the other thing is, at some point, most people say, what the hell? It's been 5 years. I've got 4 rentals. Yeah, maybe in a good month, I put $800 away. That's nothing. Mm-hmm. But what they don't realize is, or what they don't appreciate is, phase 1 is 5 to 8 years. And why I call it phase 1 is phase 2 is about reusing capital or equity, depending on what you're doing, right? So phase 2 starts with, hey, what can I take from phase 1? Is that a cash out refi? Is it repositioning debt? What we did is we did a bunch of 1031 exchanges. It's basically, I was able to recycle capital from phase 1, go from 8 units to 80 units with zero new capital. Mm-hmm. And that's when you're in phase 2. And you can't shortcut this. This is not get rich quick. You have to buy it. Your tenants have to pay it off a little bit at a time. Appreciation, most cycles, is 2 to 3% a year. It takes time, I'm sorry, but build the biggest foundation you can in phase 1 so phase 2 is funner. Don't get stopped halfway and go, what the hell? That said, hey, if you only want 4, great. You're never going to see phase 2, but that's totally okay. Right? Mm-hmm. Just know what you are ahead of time. But if you're looking for financial freedom, I'm here to tell you that phase 1 is going to be 8 years. I'm sorry. It's going to be 8 years, because real estate is about time. You need appreciation, you need mortgage pay down, you need rent inflation. It just takes that time. And once people appreciate that, then they can feel good about the building as big a foundation as they can, because phase 2 is awesome. Reuse all that capital, cash out refi, 1031 exchange. Phase 2 is where just think about Monopoly, right? Isn't it greenhouses and red hotels? Phase 1 is greenhouses. Mm-hmm. Phase 2 is red hotels. I'm sorry, phase 1 takes a while. It takes 5 to 8 years. There's no shortcuts, and get as many greenhouses as you can, whatever a greenhouse is to you, right? As far as I'm concerned, a greenhouse can be an apartment building, but just build the biggest foundation you can. Time goes by, you're going to be in a great position. Like you gentlemen, I mean, gosh, you get by your first phase, you're at 3,500 units if memory serves. Oof, it's going to be fun.
And I tell people that all the time, because I think, the key in the last minute or so is, a lot of younger people and older people today there's that shiny object syndrome where something pops up on their computer, whether it's Facebook or the internet. It's I wholesaled the deal and made 50 grand, and everyone thinks that's, oh my God, I could do it in 30 days. And what people significantly discount is that there is a time component to this, that no matter how smart or, you're gonna have to put your time in, unless, grandpa or mom and dad or someone left you a shit ton of money that no one knew about. You can get through it. You can get through it quicker. And I agree that phase one, as you say, that 5 to 8 years, even if you got inherited $30 million, that first phase, you're still got to buy something and let it do its thing. You can't. Exactly. You can't. We buy very distressed value add deals on the multifamily side, but we don't buy it day one and sell it day two. There's renovation, there's time, there's leasing. So that first part of your real estate career, whether you're 100 years old or 10 years old,
doesn't matter.
You have to put that in, and nobody talks about that. And I think it's so easy for you to go on Instagram and see some guy that oh look, here's $100,000 check. That's easy to see, but nobody knows what went into that. And that there's yes, you hear stories all the time, and it happens. And I'm not here to discourage it or make your brain not wonder. But if you really want to set yourself up for financial freedom, you have to put in time. Whether it's 5 years, 8 years, 10 years, 15 years, there's a time component that is, irreplaceable. You can't do anything about it. And that's what I think, goes unsaid. Or when it is said, I think that especially today's generation, our generation and younger, they're, I'm not doing it that way. I'm going to create an app and I'm going to do it in 15 minutes. That's not going to happen. Or there's so many other people that think that. So, put your time in, as he said, 4 properties, 8 properties turned into 80 doors, just time. And you get there. And I think that's an extremely important part that nobody talks about. And I'm a firm believer in it, because the first property I bought was in 2009. It was 2009. I graduated and became a stockbroker, made some money, and then I bought a house as my brother was becoming a junior in college. We bought a house together. It was a college rental. So it was the first property we bought. And it was, okay, college student, let's go buy college rentals. 2009, 2019, 10 years later, we went from one single house to, now it's a company that's got about, just under 4,000 units. But that's 10 years later. It wasn't overnight. And I think people look at something and think, wow, they did that overnight. And it does take time to build what you want to build.
Yes. Well said.
Yeah,
I applaud you.
I think even from, my standpoint too, it's, Michael, I forget if we spoke about it or not, but that it's a quote I've seen thrown around a lot lately. And it's just odd that it keeps popping up. It's, we overestimate what we can do in a year and underestimate what we can do in 3 or 5, whatever the hell it is. It's the same concept. It's, you want to get so much done in a year. You want to buy 4 houses in a year because you want to get it now, but you don't realize you can turn those 8 houses into 80 in 8 years, where you would have never thought you could get to 80 or 175 or 4,000 units. However you structure it, it's all different things. It's not like we sit here own 4,000 units. It's very different. So it's, it's all about, it's a thing that I've, realized a lot lately too. It's creating a plan for the long term, but having steps to get you to those places. And the first phase of your steps, you're probably going to oversell yourself and you're going to underperform. But because, 1% a day gets you so far, eventually you're going to be like, wow, I would have never imagined I can do this. And it's going to just shoot off, and you're going to have to readjust every 12, 18, 36 months, whatever it is. So I love that. One of the questions I actually thought about for you as you were talking, what do you think about people who talk about buying properties with no money down and creative financing?
First off, I believe that most of the people selling that vision are selling snake oil. Right? I think far too many people talk about it that actually do it. I think part of this is the market cycle. For example, I bought an 18-unit building during 2010, which in my market was the bottom,
right,
for zero down. I took it over from the bank. The bank had me escrow like 20 grand for repairs, but zero down deal, right? Recast the loan, the whole bit, because they were in that much trouble. They had to get it off their books. But could I talk about that in 2019 and talk about it being a zero down deal? No, because it was 2010 and the freaking world was on fire.
Right.
As long as you had capital and decent credit, and you had at the time I think we had 120 units, or like freaking take it. You're a proven operator, right? So go nuts. But I could sell a lot of books by going, hey, I did a zero down apartment deal. Come follow me. No, 2019 is not 2010. So can you do subject to? Can you do lease option? I think you can do it today. I honestly think in 2020, 21, that's going to be very hot, because I think a lot of people, if the unemployment goes up, are going to be stuck, but they're going to have 3% mortgages. And I think it's going to be a really cool idea to do subject to and lease options. So to create cash flow. So that could be a zero down deal for sure. I don't like selling people a vision that's not practical. And I think in general, most of the time you're selling somebody a dream who really needs to understand it takes work. So I'm not a big fan of that story, frankly.
And I think we made a very, very conscious decision. So I believe that if you want to do it, you can do it. I'm a big believer in, if you put your mind to it, you're going to get it done. But where that tailed off is when, we have a monthly event every month, and there was people coming over to us at the end of the event, and they brought up strategies that I know they heard from podcasts, from books, and, a zero down. And they were bringing this stuff up to us. They would raise their hand and I would say, you can do it. Do it. And that switched to, and I use this word lightly, but now I tell people you have no shot, because that story of that zero down seller financing, the seller's bringing your equity to the table with the bank, those deals do exist. But if you're coming across that with no foundation and no experience, I will bet a significantly large portion of money or anything that deal's got significantly problems that you have no idea what are about to happen, because that just doesn't appear. And there are significantly more experienced, seasoned investors in those immediate markets that have passed. And if it's coming to you after reading a book or going to an event, exactly, you're overpaying, you're making a mistake, or there's there's a predator out there. They're giving you something, hoping that you mess it up. And I tell people now, you can't, because I don't want to see them make those mistakes. Because I agree, these strategies will come back when something goes bad. And the people that have the cash, have the experience, and are local experts are going to pick them all up again. And I made that conscious decision, not to discourage people, but to hopefully protect people from making mistakes. And I'm 32 years old. I did not go through a market correction. I bought properties at the bottom, but I've learned from the wins on say, wow, that might not have worked if I bought it 3 years earlier. Yeah. And I've taken a very, I don't want to say a conservative approach, because everyone says they're conservative, but I've taken a very negative outlook. Even in the office, it's you got to be kidding me. And it's like, I'm just super negative because it's gone on for too long. And it's just like Bitcoin. When your grandma's sister's cousin's neighbor comes over to you and says they're buying Bitcoin, you sit there like, oh shit, I've seen this. I've seen this episode.
I think there's two things you said there that Chris and I jumped on my show that we should jump on again. First and foremost, I think it is so arrogant of any individual to enter a market or a time and think they're special when there's dozens of people like us in that market that have already passed. Why do you think it came to you after reading a book or listening to a podcast? Are you really that lucky? Hey, maybe it's your next door neighbor's dog walker's birthday. Whatever, right? Maybe. But come on, I have a special phobia for California investors, right? Because we have all these $1 million dreams and everything's freaking expensive and everything out in the Midwest is cheap. They're getting taken advantage of. I can promise you that there are people in the Midwest that see a 408 or 415 zip area code when we call. Price goes up. Price goes up 50 grand, 100 grand, easy. Because people in California are being silly when they invest out of state. So that's the first thing. And then the next one is, you've got to ground people, because it has gone on too far for too long. Could it go on longer? Yeah, it's a record. Anytime you have a record, could it go on longer? Sure. Is it likely? It's a record for a reason, people. And come on, think about that. So yeah, I'm generally speaking negative as well. And your last point about Bitcoin, right? What scares me about today to 2006, right? Both of you weren't investing then, 2006. So we had 8 houses. So let's just level set, right? So we had 8 houses. We had about $1 million in net, or not net worth, but in total assets owned. It was about $1 million just investment houses, excluding our primary. And every REI group we went to or cocktail party, people were talking about flipping homes. And people were actually flipping contracts. You guys laugh. I remember a tract of about 40 homes where I live that houses, the contracts were flipped an average of 3 times and they made 30 grand per flip, right? You sell it with blank land. You have the contract. You sell it to someone else when it has a structure. You sell it to someone else who's got a roof. I mean, it was crazy. And today I'm seeing a lot of that behavior, not in housing because they fixed that with financing, but in very large kind of Grant Cardone, bigger is better, right? I can't tell you how many people call me and go, oh, I only want to buy apartments. I'm like, there's only a limited supply. And how did the demand go up 600%? Yep. I mean, that ends badly somewhere, in my opinion.
It's funny because I was a multifamily investment sales broker for Marcus & Millichap, doing multifamily sales. That's what, when I decided to go onto the commercial side, that's what I picked. That was the product I picked.
And what time was this? Sorry, just so
this was 2013. 2012, 2013. And in that, so I transitioned out of the single family world when I bought 150 houses in Pennsylvania from 2009 to I ended up selling stuff in 2015 and 16. But awesome. I became a multifamily broker and educated myself in the multifamily space. And I remember when I first started looking at multifamily, because I was talking to my clients and it was the cash flow and it was all that stuff. And I look back at, yes, okay, I paid a mentor. I was in a group and it was really beneficial. But when I started that group, I think I was like the 60th person that joined the group. 1 year later, there was 120 people in the group. So it was from like 2012 to 2014, it was 60 people over 4 years. Then over the next 12 months, there was another 60 people. Now, my favorite question to brokers on our side of the coin is, you're getting 20 offers. How many new syndicators? How many syndicators come together with 18 other syndicators to buy the deal? And how many people are you selling to that have repeat transaction in the market? Because the first 2 numbers are astronomical, and it's the repeat buyers are so far down the totem pole because, like you said, it's back in that time when we didn't know. You're flipping a piece of paper 3 times by putting a shingle on a house. Exactly. It's the same thing today where I'm getting blast emails for deals that I saw 12 months ago, and the price is up $4 or $5 million, and I'm like,
exactly,
nothing's happened, nothing's changed. I mean, we see it all the time, and we just sit back, and I don't, I'm not laughing, but it is comical because that's a recipe for disaster.
Yeah, no, 100%. I thought of 2 interesting things. I was talking with a guy actually just earlier, and he was calling about one thing. He's like, I actually spoke to somebody yesterday. He's like, I want to give you, like, not me, to the guy I was talking to, I want to give you $2 to $3 million, and I want to go buy apartment buildings with you. And I was like, that's great, but I don't, that's the type of stuff going around. Like a guy who's bought a couple single family stuff, has a guy reaching out to him to place a couple $1 million, and I know really nothing about him. So he could potentially be the best operator in the country. And I don't know, I had a short conversation, but though the people with money, that's the stuff they're going for. So it's more of a reflection on the person I know nothing about, but that's what's happening. They hear about stuff going on. They're like, oh, I just want to get into apartment buildings. I don't care what you're doing. I just want to get into apartment buildings. Yeah. So I just think
this is 06 all over again. They are going to get hurt, and it's going to be painful. Their money's going to be locked up. Their best case scenario is their money's locked up for a decade versus 5 years. Yeah. Their preferred return goes from 6 or 8 to 0. Worst case is all that happens and they get capital calls.
That's the killer.
For sure.
I mean, as a sponsor that's not well capitalized. I talk about like businesses go out of business. I'm reading Shoe Dog, the Phil Knight's, the Nike story. And he talks about early on in the 60s, companies that fail are not well capitalized. If you're and luckily, my partner has, he's helped our business significantly, and I give him all the credit in the world. But if we didn't have the capital that we had, and situations came up, even from a standpoint of the bank doesn't pay the insurance on renewal, you have to lay the check out and then the bank reimburses you, 60 days later, whatever it is.
Exactly.
Little things like that, people don't take into consideration. And that, like you said, you're not well capitalized. You do a capital call and you're a sponsor and you have a pref and you're not hitting it, it's over. I mean, there's no money to be made in that deal and your name's tied to it and you got to operate that thing for 10 years.
Yeah, well, let's just have some real conversations. Again, no names mentioned, whatever, but I can tell you what'll happen is there'll be a few operators out there who have that happen. They'll rob from Peter to pay Paul, and that's a Ponzi scheme, and you go to jail for that stuff.
Yep.
There will be operators that go to jail 5 to 8 years from now because they.
I agree because I even see it. We had 1,000 units, about 1,000 units in Jacksonville. I personally believe that our basis is rival what's been going on in the market. And we're seeing deals that we passed on that are literally being purchased for $2 and $3 million more than our offers. Now, maybe my offer was low, but there's a difference between low and $3 million.
Yeah.
And these deals are transacting. And you're sitting there, it's like, okay, either the market's that good and I'm missing something, or there's a mistake being made. And I agree with you. People, what I envy to a degree, and this, if our listeners are listening, they're going to be like, this kid's crazy. I love it's just you and your wife. I think that there's something to be said about that. That's something that, you pat yourself on the back. That's fantastic because you hit a number, you replace 2 6-figure incomes, and it's great. And we talk about it all the time. I mean, I love our business. I love our investors. I love our bad investors and I love our good investors. Maybe not the bad investors as much. And there's earlier shows where I trash them, but there's a level and there's a component of me when I first started, I wanted the biggest company in the world and I wanted billions of dollars. Now, as maybe I'm getting out of that first phase, I look back and I'm like, there's something to be said about picking up 100 units for myself or maybe me and a buddy of mine where I don't have to answer to anybody. I don't have to do investor relations. I can go to bed at night. I can go home and play with my daughter. And I know that if it does well that month, it does well. If it does bad, well, it's okay. It was a bad month. And there's something to be said. And I think you have to be in the right mindset to start taking on investors because, when you start robbing Peter and paying Paul, shit goes wrong and you are doing stuff you're not supposed to. And I think there's people out there that aren't looking at the consequences. And then there's people that are doing it currently that, there's something to be said. And I like I said, when you said that early on, it's something that, you really got to think about when you're getting into this business is what do you want to do and what do you want to be? Because there's something to be said about owning 200 units by yourself with no investors. Mm-hmm. You have no headaches. You can rob from Peter and pay Paul. If one house is doing good or one building,
it's all mine.
It doesn't matter.
As long as the wife knows.
Exactly.
Yeah, exactly. Believe me, she knows. She runs the book. She's the smart one.
There you go. So as long as you know.
Yeah, but that's something that I think people have to be aware of because there will be sponsors in business today. We sold a deal, and I saw the acquisition fee from the buyer, and I was like, holy shit. One of our investors, we were buying another deal, and our investor literally called. He's like, is your acquisition fee market? I literally just sent them the closing statement of the other deal. I said, here, do you think it's market? This guy's charging 5%. We're at 1%. I said, is it market or not? But that's a perfect story of someone that, hopefully they're around 20 years from now. And I never wish ill will on anybody, but there are people doing some crazy things because that's how these people are getting money. They're making fees.
I didn't even tell you about this. I just thought about it now. I had a conversation with somebody in a similar role as me who's been there shorter time. And he's asked me questions. Like, what? He's like, have you guys started taking less on your splits to get deals done? And I was like, what? And he was like, yeah, like over your pref, will you take, instead of a 70-30, will you take a 90-10 or a 85-15? I was like, no. I was like, are you guys? He's like, well, not us, but I've had other people tell us they're doing it. So the fact that there's now people out there cutting their margins on what their company or them themselves as the operator is going to make on these properties to get a deal done either means they're just doing it to collect fees and they don't really give a fuck, or now people are just squeezing margins so tight, eventually, the shoe's going to fall or whatever.
So you're in California, right?
Mm-hmm. I am.
So California, I know early on in the 2009 to 15, if you were fixing and flipping houses, and I did a couple of fixes, it was 65% of the ARV minus rehab cost.
Yeah.
Probably very similar to the California. That margin, that 65, and I know you guys went through a program on flipping houses. That 65 has now become 85. So that's that recipe all over. It's just that now these guys, you do 85% of the ARV minus rehab cost. If you put a nail in the wrong hole, it's over.
Yeah.
If you have to do a new sheetrock, you have no margin. And if people are lowering their margins to get deals done, I can rest assured that deal will not perform in the future, because but that's a scary thing. But that's the stuff that's out there. As Michael alluded to, conversation you've been having, people are doing things to engineer deals on paper, to get them done.
Well, that's one of the brokers we were talking to said that too.
Well, here's the real challenge, right? Money still is awash in the system today. There's a lot of money, and people want to place it because interest rates are low, or all of that. But here's the problem: I vet an operator by what deals they don't do.
Mm-hmm.
Right? Some operators are like, shit, I just got another guy that called me that wants to give me $2 million, to use your earlier example, and they feel they've got to do a deal, and hence they reduce splits, and they'll pay an extra $1 million or do these things so they can place the capital. No, a good operator says, no, the market's hot. It's not the time, but it's hard to say no. It is very hard to say no. And that's what it's like a builder. They build until they don't run out of money.
It's funny.
Yeah.
We have an amazing employee. She's great. She cold calls all the time, and she always talks about, I want to develop. And every deal, there's a development component. And I said, developers are the first to go completely upside down, because they build until the market blows up, and they start with one house, then they build 3 houses, then they build 9 houses. And then by the time they get to 10, the market blows up, and now they have 10 things they have to support instead of 1. And I tell her all the time, I said, and I actually forwarded a Grant Cardone post. I forwarded it to her on Instagram, and it said something along the lines of, I don't mind paying the builder a premium for the product because he's making his fee and leaving. I'm going to own that for 10 years with cash flow. Whether you like Grant Cardone or not, I said, do you still want to build? Because you buy the cash flowing asset. Don't try and make 10 of them, because that's when things go sideways, in my opinion.
Yeah. When he was talking, I was thinking of the Jacksonville deal we passed on.
Yep.
So there was right after we closed on our first deal in Jacksonville, it was an 82-unit property, which is done really well. We had under contract an 86-unit, and what was it? They wouldn't release the credit histories of all the tenants.
Correct.
So we were under contract coming up to our go hard date on due diligence, where deposit would no longer be refundable for somebody who doesn't get it. And we had to make a decision whether to close, not having the credit history of the tenants. And he had just brought it from vacant. So it was a vacant building. He brought it up and leased it. It was leased and there was revenue coming in, but doesn't mean that they're not going to be able, that they're not all going to leave in 6 months. So we were like, fuck, what do we do? Like, we really like this deal. We really like this market. And we ended up passing on it. Yeah. And one of our manager's other clients closed on it, and the guys just absolutely crushed it. We're so pissed.
It's something but
to your point, it's one of those judgment calls that you have to make, and to pat ourselves on the back a little bit. We feel we made the right judgment call with the information we had at the time. But looking back, we're like, oh my God.
Frankly, I would tell that story to every investor.
Yep, and we do.
Oh, we do. Yeah. We abuse the hell out of it.
It shows that the discipline's there, that if we're not going to get what we want, we're out. Now the numbers behind that, it was all in at 60 a door, and the whisper price, they're trying to sell it for 100 a door. Huge home run. But we didn't get the absolute, that deal could have easily went, you bought the deal, all the tenants went delinquent, and now you're sitting with a mortgage. So we do tell it, and I have no problem with saying, yeah, you know what, another deal.
The Montgomery one is even more.
Montgomery, forget that. I'm talking about Charleston. My partner was the major equity player in a deal in Charleston. It was 288 units. They bought it for 20-something a door, crushed it. They made 3 times their money. They sold it for 45 a door. They sold it to a group that ended up putting in 20 a door, all in at 60. That deal just traded or is trading at 105. And now that was a deal they did. And at the time they had a decision. It was put more money in, get a new loan, and take it to the next level, or sell it as is. And their decision was sell it as is. There was other factors behind it, but they made a huge profit at the same time. You look back, you're like, wow, you could have made more, but no one's going to fault you for taking a profit off the table when there's a profit existing, and simultaneously knowing the deals that knowing why you're passing on a deal and being disciplined to, if it doesn't check off my box, I'm not buying it. those are stories people don't talk about. It's easy to talk about the wins, but not the ones that hurt, whether it was a good deal gone bad or a good decision that at the time was the right one and the deal ended up going great. But it's something that people have to know. And I think that, when you're vetting sponsors, because this is something that people don't talk about, those are the right questions. Don't tell me about the 30 IRRs. Don't care.
No.
Tell me about either the deal that didn't go sideways and how you fixed it, or tell me about the deals. How many deals do you underwrite and how many deals do you buy, and why did you pass? Because I want to know that when you bring a deal to me, that it's not going to go sideways, or it's everything you guys wanted. And I think that's an important part.
Yeah, I would only in today's market where there is no question we are closer to the end than the beginning. I only want to talk about stuff you pass on. That's all I would vet you on.
Yeah.
The whole let's turn a building around and all you save the day and blah, blah, blah. That was kind of great from like 15 to 18 where the value was moving around. Today, it's all about what you don't take, because there are people flat out overpaying and promising returns that just won't happen. Won't happen. I've owned them. They won't happen.
Mm-hmm.
Yeah. Well, that's when we were just on our trip in Jacksonville, we had an investor come with us and just, flew down his own, wanted to come check it out. And we were talking about another deal he was going in, and we just happened to know it very well. And we were like, look, we know the deal. I don't know if he's overpaying or not, but I'm telling you right now, it's not going to make the return you think it's going to make. Because it was like a 2,000 something bill property. He was saying it was going to make it was a core deal. It was like an institutional grade property basically. And he's telling people they're going to make an 18% return in 5 years, 18 per year.
Yeah.
And I was like, look, if you go into that deal and you expect to make 10%, you'll probably be fine. I said, if you go in expecting to make 18, you're going to be very unhappy.
Yep. He agreed.
And he understood, to his credit. And I said it to you when we were gone. I said, we had spoken a few times, but we obviously, when you're with someone for 2 days, you get to know him better. I said he was way sharper than I thought he was going. Not sharper. He was more educated on real estate than I thought he was going to be. And whether he was lying or not, who knows? But, he might have said it. Oh, yeah, of course I did. And inside he's going, oh, shit. But no, I think he knew. He was like, okay, I know on this I'm probably going to make 10. But he's from the area. It's a nicer product. He's diversifying across several different types of assets. So I think he has a good head on his shoulders for that investment. But yeah, I'm sure he's one of 50 and the other 49 aren't thinking like that.
Yep.
Yeah,
but what happens when 5 of those people get all pissed off and they want to sell their shares? Or it's just going to get messy.
I hope you have good documents.
So that the messy component, that was just I don't joke around, but there are a handful of people that I talk to off the record. And when a deal trades, I call up and, I call my buddy. I'm like, yo, you see this shit? Like, I guarantee lawsuits are going to be filed. There are people admitting things off the record that are scary, because you're coming from, you're coming from a position of power, right? You don't have investors. You could talk with however you want about these deals and you're looking at it, but you're right. 50 people, 40 of them are never going to care if the deal goes well or goes sideways. They don't care. They wrote a check. They're probably going to forget they invested in it. 10 of them are going to be in various arrays of, I'm very involved. Okay, it's not going well, whatever. And then there's going to be a handful of guys, whether it's 2, 4, 5, 7, that are going to be up your ass at the first miss. And then when they see it going the other way, you're just setting yourself up for a headache. And what's more important for us today, because we did it, I've had the headaches. We vet our investors more than they probably vet us. I had a conversation with a group today, and I was like, this is not going to work. Like, well, no, we're looking at things the same way. And I said, guys, you want me to show you a 22 IRR under your own admission? You want it to look like that. You don't care if it performs or not, but now you invest. I have to answer to you. You're going to answer to somebody else. This is never going to go well. And I think vetting your investors and that is more important in today's market than anything, because that's how a sponsor is going to get, sick to their stomach. The last thing you want your sponsor to do is pull the ripcord or wave the white flag in, because then the whole deal is going to go sideways.
Yeah. Boom.
Or you got to spend 10 hours a week on phone calls with investors every week, updating them on the 5 different deals they're in. Now you're just wasting time. You're throwing money in the garbage. So
correct.
Not only are you not working on these deals to get them potentially performing better, you're now also wasting time trying to alleviate these pain points, which probably aren't going to go away.
Correct.
So it's crazy.
Question for you: when you made the conscious decision to go, buy a house, buy 2, buy 8, did you want investors, or you knew out of the box that was not, you know, it's not what we wanted? And I'm sure people ask all the time, hey, you know, hey, take my money.
People do all the time. And I do take some private money now, but I never pool capital. So single asset, single investor, right?
Yep.
So I have one person. I never, the only person else on that is my money.
Yep.
Right. So that I don't pool capital. But I didn't do that until I retired. Right. So that'd be like 2018-ish.
Okay.
People asked all the time for money. I was not about complicating my life. I didn't want to answer anybody. I was comfortable risking my money. I only had 15 minutes a day to look at this stuff, and I didn't feel I was in a position. I didn't want to complicate my life, and I could never afford losing somebody else's money. That would just kill me.
Yep. So I feel like I get the question all the time, you know, I'll pay you to mentor me. And I said, if you're paying me to mentor you, am I really doing you a service? Because I have a business with investors. Simultaneous, what do you want me to teach you? You want me to teach? If I'm giving you the time that you need, I'm not giving them the time. And if I'm giving them the time they need, are you getting what you're paying for? So complicating your life is, you know, I tell, you know, that my saying now when people ask me is, you know, you want $1 billion business or you want $1 million business? Because $1 million business can generate the same amount of money for you as $1 billion, just you're going to have way less headaches.
Exactly. That's what people are missing. And people come up to me all the time like, hey, why don't you go bigger? Why don't you go bigger? Why don't you? Dude, you don't understand how great my life is. you want to do the success, happiness scale like Gary Vee talks about? I'm in a good spot.
Yeah.
Right. It doesn't need to be twice as big. There's absolutely no reason for it.
I know.
Well, will it ever get twice as big? Sure. But on my pace, not your pace.
And that's the key word right there. It's, you got to do it at your pace. Cause I know out of the box when I was 26 or 25, when I started, you know, I wanted $1 billion company. I'm 32, married with an 8-month-old daughter.
Oof, yeah.
You get that $1 billion company. I still have dreams about it, but you know, give me 1,000 units with no headaches, and
amen.
I'm happy. And I think there's something to be said about happiness. And you know, you gotta, you know, the more problems you make, the more problems you have. It's not worth it. You know, eliminate it and do. You know, that's my. You know, listen, there are people that love headaches, but. I'm not
each his own, man. No, yeah. I tell people all the time, just plot yourself on your happiness scale, right? I have worked with lots of people that made $1 million a year selling software. That was what I did for a living, right? And if you kill it, you can make $1 million W-2. But if you look at everyone I've ever known that made $1 million, their life sucked. They were addicted to something they shouldn't have been addicted to. They were probably cheating on their spouse. They didn't know their kids. It just crushes you. Right. Yep. I would much rather be, you know, somewhere else on this success scale, but happy. Life's about being happy. It's not about frankly, it's not about vanity metrics. It's not about 1,000 units. It's not about 200 units. It's none of that. It's what you said. I want the cash flow.
Yep.
You want to talk about a number with me? Talk cash flow. Don't tell me you got 5,000 units, because I know you can have 5,000 units and lose your ass.
It's so true.
I'd rather talk about 5 units and let's talk about that number. No. Go ahead.
Yeah, I think part of it too is just everybody's got to know themselves and back into what you want.
Yep.
And then figure out what is going to get you there. So if you want $1 billion company, you can't go do 175 units. That's never going to happen. Even if you've got a staff of 2,000 people, you're going to have tens of thousands of units. You're going to have to be in different asset classes, different countries. But if you want to just live comfortably, you don't need that. You could have 8 rentals. Live comfortably is so subjective to where you want to live.
Correct.
Do you want to live in LA or do you want to live in West Virginia? Mm-hmm. Two very different things. You can go live in a trailer for $300, no responsibilities. You own 4 rentals. Guarantee you're not going to have to make a nickel for the rest of your life.
You're covering everything. Yeah. But no, I think that's important. I think working backwards and understanding that is great, because, you know, like I said, you know, our concept, the way we did it and the way you did it, a little different to a degree. You know, one rental at a time is the easiest way to look at this business. You know, go find that one that's going to check off every box and get rich slow.
Yeah.
Or educate yourself and go buy a 4-plex or a 20 and make that your first property. Yeah. It doesn't matter. But I think that's, you know, that's key. The key is working backwards off of that, because, you know, Michael's got one way to do it. We have another way to do it. Whether we're at the same point or different, it's irrelevant. You know, that you want to be where you want to be, and no one can tell you what that is.
And you should never judge anybody for what their goal is.
Yeah,
exactly.
100%.
Yeah.
And
I totally agree.
I think another part, I think I've seen it more as I've talked to more people as they're not sure what to do. I think everyone's scared that once I do one thing, I'm that thing. And like so easy to change. Like you're talking about it. I wanted to be $1 billion company.
Yep.
I wanted to do student rentals. I bought 100, like how many different things have we gone through?
Yep.
And nobody's saying that you can't stop this one and go to another or continue to do this one and add something to it. And I think change is way too, what's the word I'm looking for? Like put down in either our space or society, country, whatever you want to say. Changing your mind is great. That means you're growing and you're learning things and things are changing within yourself, and that's just natural, and things are going to change. So if you're scared that, I don't want to choose one because I may waste time and I may not pick the right one, you're going to have to choose one at some point or you're going to do nothing. So you might as well choose one quickly, figure out quicker it's not the right one for you, and get to the stage of figuring out what the right one is way quicker than if you spent the next 6, 12, 18 months trying to find the perfect avenue by reading one book on every subject. It's never going to happen. I mean, that was me. I went from flipping to tax deeds to small multifamily to large multifamily. And that was a 18-month process.
Yep. That's 80% of the people I talk to. What you just talked about, the shiny object syndrome or whatever you want to call it. 80% of the people that get a hold of me are somewhere in that conundrum of this or that or this or that or this. And they do nothing. They never get off.
And that's what I say. I say, the best decision you can make is buy something.
Yeah.
Yes.
Fuck it up.
Write an offer. I mean, you write an offer.
Exactly. You gotta. That's the thing that every book is going to show you the best part of the business, or it's going to give you enough rope to hang yourself. What it won't do is physically get you to write an offer or buy something. And I tell people all the time, like, well, I could pay this coach, or I could buy this, or I could do that. I said, just go buy a house. Go buy a house, fuck it up, lose some money, and be like, wow, that didn't hurt that bad. That is the best education you're ever going to get. Because when you get thrown into the fire, two things, you're going to realize this is an awesome business, or you're going to hate it. Yeah. And that quick decision will help you so much more than spending 10 years trying to figure it out.
Yeah.
Either answer is great. If you love it, awesome. If you hate it, awesome, right? Quick yes, quick no.
Yep.
Much better than a slow maybe. Absolutely.
And even as you're talking, as you went from either like or hate real estate, as it's more meta too, even me personally, I went through 3 or 4 different employment things before I got there. I went from being a coach to, well, I guess 2, being a coach, working in finance as a stockbroker, and then made it over to real estate, and then went through 3 different assets until I've landed where I've been. So it was, 18 months of real estate and 2.5 years of other shit before I even got to there. And now it feels like the blink of an eye. It's sitting back now where it's like, okay, that didn't feel like it took that long, but it's been fucking ages.
Yep.
But it's the same exact concept.
Do you recommend in your market, out of your market? What do you prefer? Where do you own? What does that look like?
That's a good question. So I live in Mountain View, California, which if you don't know it, you can think of Bay Area, Google, right? Google's the big employer in Mountain View, California. So I live around a very, lots of high paid engineers and software folks. So my real estate's expensive. I believe you live where you want, but invest where it makes sense. So for me, that means I couldn't invest in the Bay Area. I wasted a year doing what the book said, right? Every book I read said, invest 30 minutes from your house. Mm-hmm. I looked every weekend for 52 weeks in a row, and that magic street doesn't exist in the Bay Area. It just doesn't. So what I did is I pulled out a California map because I traveled all the time. The last thing I wanted to do was get on an airplane. I traveled 200,000 miles a year. I freaking hate flying. So no airplanes for me. So the first market I found was Fresno, California, which is a 2.5-hour drive one way. So it's a 5-hour day just to look at one house. And we have been in that market since 2003. We rode the wave up. We crashed hard, and now we've ridden it back. We never left. Again, what makes me happy is I now have a team there. I have property managers, contractors. I have a network of people that bring me deals now. No marketing costs. We have toyed with going to other markets, but I look at it going, do I want to complicate my life? No. Do I want to hire property and fire property managers again? No, because that's terrible. It takes forever. And I'm never going anywhere else. But if you want to go out of state, I think it's fine. But if you're going to go out of state, get on an airplane and go check it out. Go kick some rocks. Don't look at Google Maps and freaking Zillow and tell me you've learned your market. you're just going to freaking lose money.
So we have like a 5-minute overview of what to do if you find a deal, right? You could do everything online, but the last thing it says is, basically get the fuck out of your chair and go there. Because I tell people all the time, there is something to be said. This may be the best deal in the world. It may make 100% a year, but if you utterly despise going to wherever, whether it's middle of nowhere or downtown LA, I don't care. If you hate going there, if you buy that deal, you're an idiot. Because you have to enjoy and like doing it. That's why when people ask me all the time, when I first started, I read my first real estate book. I took out a map. I put a pin where I lived, and I drew a 4-hour radius. I said, I'm okay driving 4 hours away. 4 hours from Long Island, I land in the Atlantic Ocean. There's nothing to buy there, so it really only pushed this way a little bit. But I tell people all the time, I said, that's what I did. Is it the right way or the wrong way? I don't care. Maybe right, maybe it's wrong. But if you have to enjoy going. We own deals in Jackson, Mississippi, and Mobile, Alabama. I utterly hated connecting flights and missing flights and getting stuck in Charlotte and Atlanta. I hated it. So we made a conscious decision, no more of that shit. It's got to be 2-hour flight because that works. And it also has to support the travel. And I have to like going there. I enjoy going to Jacksonville. I like going to Columbus. Meet good people. You have to like it. If you do not like going to your market and you don't have a good team set up, if you buy that deal, you're an idiot. I don't care if it does well or not, because you're adding a level of complication that nobody needs.
Dude, you walked up to the crash table and put it on 17. Yeah, 17 hits once in a while.
Exactly.
You're still a freaking idiot.
Yep. No, I agree. So that's why because I think people always, it's an interesting question, right? People, should I invest in my backyard or not? We live 20 minutes from Manhattan. My backyard, good luck. It's very similar to where you live. I think we actually probably are the 1 and 2 most expensive affordability.
Absolutely. Least affordable,
up there. So we invest out of state. There's nothing wrong with in-state, out of state. The biggest thing is that you got to be comfortable with it, and you have to, I can't read, I tell people anytime I speak or at our event or even on a podcast, if you listen to a podcast or you read a book, pick one thing and remember one thing from that episode, book, event, whatever it was, and implement it. And if there was anyone listening here today, he lives 2 hours from where he invests, 2.5 hours. We go to your market, be there, understand it, because that's important.
Yeah.
Amen.
And I think it's important, just as an example for differences, I would never do what you did because I hate driving more than an hour and a half. I can't stand it. I hate driving more than an hour and a half. I would rather fly 4 hours and drive an hour and 45 minutes. Because in a plane, I feel like I can do things and get up and whatever, but that's just me. So I would much rather invest over on the West Coast than go invest in Southern Jersey, because that's going to take me 3 hours to get to. That's why, when I met him, when he had the 150 houses in Philly, he was kind of showing us the ropes, and that was the third thing I tried to do. I hated it because it was 2 hours there, 2 hours back. It was also rough as shit, so I didn't like it. But I was like, it was just like I was like, this sucks. So we realized very quickly that it wasn't for us, because a couple of my family was still doing it at the time, but that was me. You easily could have done very well there. He was the proof of that, but it just wasn't right for me. So I think it's always really interesting. You're the first person I've heard that said I wouldn't fly. I feel like most people lean towards flying. So it's very interesting to hear that.
Well, you got to remember, I was doing 200,000 miles a year,
with
3 to 4 different cities for my day job. The last thing I wanted to do was see another goddamn airplane.
Yeah.
Well, so I say it all the time. I don't mind. All our deals, we don't own anything in New York, but so we're implementing a very large mobile home push, and the mobile home parks we are looking at are all in New York State within a 4 or 5 hour drive, because 4 or 5 hour drive is exactly like a 2 hour flight, because you got to get to the airport early. Sure. You got to park. You got to
not for me.
It rains. The flight gets delayed. There is, if at least in a car, it could be torrential downpour. If I want to get in the car and drive home, I'm doing it. Right. I have no control over. And at the airport, they lie to you. That's all they do. They're like, yeah, we're getting delayed because of whatever. That's not why they're getting delayed. They're getting delayed because they just don't want to fucking go, right? They just tell me the truth. You're fucked. You're not leaving. You're gonna sit in the plane for the next 45 minutes, and we're not gonna move. I don't like that. But there's another reason. I also I want to be able to see, feel, and touch it. I want to learn how to operate it. And in my backyard, I don't mind jumping in the car and driving 8 hours, 4 hours there, 4 hours back, because I can make calls. I can call investors. I can follow up. I can do things while I'm driving. I'm not supposed to be texting, but I don't.
You don't do that.
No, I'm not texting, but no, I don't mind the drive, because I'd love to invest in my backyard. And that's also partially because, having an 8-month-old daughter, I don't want to spend the night in another market. I want to come home. I want to give her a kiss. I want to play with her. So I agree.
That's a great point. I mean, one of the things that people still laugh at. So I've been in Fresno almost 20 years. I have never spent the night in Fresno.
There you go.
It's 2.5 hours there and back. I can be in my own bed. I've spent hundreds of nights in hotels for work. I am not spending another one for my real estate business. It's just not going to happen.
And see, those are things that when people are talking about, people, well, give me top 10 markets you invest in. I said, what's it matter? I said, go home, brainstorm. You want to go to the beach? Pick 10 beach towns. You have a family that lives in Austin, Texas? Put Austin, Texas on the map. But that's not unsimilar to me, and why, maybe the goals are changing or whatever. But, sleeping in a hotel belt sucks. I like my house. I like my bed.
I like sleeping in hotels.
But that's why you're
nice hotels.
That's why we love.
Wait 10 years. Wait 10 years. That feeling will wear off.
Sure. But that's why we love Chris, right? We're going to
But again, going back, it could change. What does it?
It could change.
Yeah.
Doesn't matter.
So if I was on my own in 10 years, I hated hotels, I'd go invest in Philly and I'd drive.
No, but that's the important part.
In 10 years, it'll be autonomous cars, so maybe I will drive.
It's like flying. No, but no, that's why I asked the question, because I think people, everyone has a different philosophy, and I think there's reasons behind it. And that's, it was I asked the question so late in the podcast because people got to know you a little bit more. And now it's something that hopefully someone can use as a tool when they're trying to find a market, because San Francisco, the Bay Area, super expensive. So if you tell me you can't do it, Michael's doing it, doing it extremely successfully. So if you tell me you're not doing it because you can't afford it or it's expensive or the market sucks, you don't really want to do it, because you can do it. Get in your car, drive 5 hours. You're going to hit a market that is definitely affordable and clearly cash flows well enough to check off a lot of boxes.
Yeah. Can you spend 2 to 5 minutes on 03 to today, buying in the same market and living through the downturn a little bit? Because when we spoke, you spoke about things that I didn't realize and I thought was incredibly interesting. I think people get a ton of value from it.
Yeah. So I think one of the things that caught your attention is how the lending environment evolved, I think was one thing you hit on in our interview. So 03 to kind of, let's just say 07, lending was easy and got easier the later in the cycle you got, right? I mean, it got so bad that they weren't even checking documentations for correct spellings and socials and stuff. It was bad, right? It was just bad. And then 07 happens. It kind of rolls over. And, the first thing that happens is they pulled credit lines, right? You had a credit line. They were giving credit line out like candy. The credit lines got pulled immediately. And then prices were going down, right? So I was finding deals. And I wanted to go get a bank loan. And again, 800 credit score, 7-figure net worth, 6-figure income, never missed a payment, never late, reserves. And they said no. So lending can change in the blink of an eye, right? There is fundamentally, one of the reasons that the depth of the depression or the recession was so bad for real estate was because banks simply turned off. They just turned off. And you just had to get creative. Again, you could either sit down to some of the earlier points or you could figure it out. So we went hard money first and realized that was expensive. And then we took some private money. Again, single asset, single lender. But people were very happy to earn 10%. We were paying 10% interest only for several years because we didn't want to miss the opportunity to buy everything we could. And prices came all the way down. And then one day I remember I was getting 3 to 4 phone calls a day from REO agents, real estate owned, basically bank owned stuff. And suddenly my phone stopped ringing. And, after a couple of days with that, you're like, what happened? Well, it turns out the hedge funds came in and they basically went to all the RO agents and bought everything, portfolio. So the game changed again. This was like 2014, 13, 14, and still lending's off. And, I couldn't get a bank loan other than a commercial property. I couldn't get a bank loan or a residential loan until 2018. That's how long lending was turned off for us. So that was the lending, right? So we talk about real estate cycles. I am a firm believer there's lending cycles, and we'll see another one. I think lending gets easier for a while. I think they get more creative because they're not making their spreads and all of that. But maybe 2022, 2023, lending's going to have a hiccup again, and you're going to think you have a credit line, and it's going to get taken in a blink of an eye. So
absolutely. The first multifamily deal I did was 100% recourse with a 5.25% rate. Totally a product that just, if I told people that today, if I brought that to the table today, investors would look at me like I was completely insane. But they're definitely, and that's coming, 2014 was a period of time where they were just starting to get back into the lending world on the commercial side. They were just opening, everything was still pre-review with Fannie and Freddie and 65% leverage. But now that, now there's lenders out there. I mean, you could almost get anything you want, but I agree. I mean, lending cycles are huge dictators to, real estate goes like this, the lending will too. Your lending, it's going to correlate a little bit. Your lending's probably going to be a leader to a disaster because they're typically, hopefully from 2007, they've learned their lesson. But, you're seeing it now, 3% down and FHA. You're seeing stuff that blew up in their face once before. Now, back in the day, like you said, you went into the bank and you're like, I make $1 million. You're like, good, great. How much money do you need? They're not doing that anymore. Now it's a little bit harder, but the lending world is the first, they're the first ones to push the envelope before something blows up, and you're seeing it today. So, I agree.
The signs are there.
Lisa, a couple times when I've been with her and we'll talk about deals and stuff that we're buying, she's like, I had a chance to buy that for 11 a door back in 2011. And the thing's selling for 50, 60, 70, 80 a door, 100 a door now. And I'm like, why didn't you buy it? She's like, well, I couldn't get lending. Yep. So you'd have to buy it all cash. And I guess she may not have just had the, on the bigger stuff, I'm sure it's harder to find an individual to do a loan, for $8 million or, I guess 8 million would be a lot. It'd probably be more like 2, because 200 units at 11 a door. A couple $1 million, probably harder to find. It wasn't like Fannie and Freddie were just sitting there writing hundreds of billions of dollars worth of, commercial loans every year. Yep. Like they have been basically since I've been here. Oh yeah. I mean, that's a huge part. I mean, the lending animal is the one that will lead the way because there's a reason why deals, the basis, like we're big on basis. So I think basis is super important, but a $35,000 a door basis today was $10,000 5 years ago, but 5 years ago, or maybe 8 years ago, $10,000, there was no lending. So you're 100% cash, your unlevered return, you weren't levered. So your return was what it is today, but today, because of lending, it whacks that out of proportion. So I still believe that 35 a door is, even if the world were to end, 35 a door is still a really safe buy. But at the same time, you're right. Back then, we just came out of the worst recession ever. People were very nervous. Your grandparents or great grandparents might disagree with you. They may disagree with me, but they're not here to tell me.
Exactly. It's the worst one we have seen.
Exactly. Yeah. So, that's why basis is important. And I think that's where, a conversation I have with an investor today, he's like, I don't want the financial markets in the future to dictate if this deal is going to work or not. I'm like, no shit. If they pull back lending and someone gets 65% LTV, you're not selling your deal at a 5.25 cap. You're selling your deal at an 8 cap because it just, people aren't going to take, people want a certain dollar. And they're not going to bend on that. And that's you got to keep a close eye on the lending markets because that's what's going to be the indicator to shit going sideways. Or they may just pull back and say, "Well, we're a little scared," but they make mistakes too, and they made major mistakes.
The other thing I was just thinking of is, financing contingencies are basically gone now.
Oh yeah,
commercial offers, I guess. My first year, I think we still had them.
Yep.
But now if you have a financing contingency in your offer, you better be the highest offer by a good margin or you are not winning that deal, especially at least in the markets we're in. I can't speak obviously for every market, but I would assume that top 50, 100 MSAs are probably the same, or the cities, whatever, especially in, over 100 units.
No doubt.
Because it's so easy to get a loan today.
Absolutely.
I can't wait until the first group can't get a loan when they don't have a financing contingency.
Yeah, it's going to be brutal. Because, hard money when we first started, you put up, 50,000 hard and it was like, oh, wow, give them the deal, right? They're willing to lose 50. But it was okay. There's no doubt. There's no way this deal's not going to work. We're going to get everything's going to go well. Now, 50,000 hard. You're not. It's like $500,000 hard. I mean, we hear people close in 30 days, 500,000 hard. I'm like, how am I going to compete with that? I can't close in 30 days. I'm not going to do it. But that's like to the full extent. There will be people, 2022, 21, 23. I don't know, but that lending world is going to change, and that's going to be the first. Maybe it's the first kick in the nuts.
It will be. I mean, the lending is going to cause problems. There are people betting their business models. And the sad thing is they're doing this in housing with flipping, but it's happening in commercial stuff. People are making conscious decisions that they're going to be able to get out of something in 3 to 5 years at a lower rate or increased value or appraisal or whatever it is. Fucking lending is going to change, man. And they're not ready for it. They're done.
You talk about flipping today is like flipping 5 years ago is multifamily today. Over the last 2 months, I've had 4 or 5 people bring to me, I want to start a hard money lending business. I'm like, what? What the fuck do you know about hard money lending? Like, well, no, we'll just lend at 85% of this. I'm like, yo, dude, you have you want to create a fund for hard money lending and you don't know an appraiser. You've never been an appraiser. Like, well, no, I want to target like $400,000 houses in these areas. I'm like, yeah, what happens if the market goes south and you have a $350,000 house that's worth $250,000? You're in a shitty position. And then, your first position, I'm like, that's only as good as what it's worth. I don't care if your first position of shit, you're still shit.
Still shit.
So this will actually be funny. I don't even know if I told you this. So when we were just in Jacksonville, John and Don dipped out early because they suck. And I was shopping comps and went into a neighbor property, and I went in. I always like to say I'm involved in another aspect of real estate in case I say something that sounds like I know about real estate, and I just don't want it to come up or be an issue. So I said I was a flipper, and I was interviewing for a new job. So that's why I was here. I'm from New York. I'm looking at some apartments if I get the job. So we're going through, we're talking about stuff because you can also ask a little bit more information like, oh, what type of material are you using? Are you using vinyl plank or rollout? And if I go down and touch the floor, she's not gonna be like, what the fuck are you doing? It's, oh no, I'm a flipper. So this is what I do. And I'll ask about stuff. And they were doing upgrades. So she was telling me, yeah, we're using, stainless and granite and all this stuff. And I was like, oh, like, what do you guys typically get for a package on a kitchen? And she'll tell me. So it's a way to get a little bit more information than a typical renter, which I think I'm pretty smart. So it works.
I was about to say that is very impressive. Yeah. That did not come from me. That was all on your own.
But anyway, so we get back to the place and we're sitting down. She's, trying to close it, obviously. And I'm like, I can't, like, I don't know, like, whatever. We'll see how the interview goes tomorrow. And I started asking her about the buyers because they just bought the property 2 months ago. We offered on it. We lost.
Okay.
And new management. So I'm asking her out. She's like, yeah, well, the owner just bought it. They bought another one up the road. They did well. They brought me over to run this one. I was the assistant, all this stuff. And I was like, that's really interesting. I was like, I've actually got a couple buddies that do, apartment complexes, but they do like 10, 20, 30 units over in Orlando. And I was like, what do they typically do? Like the guys I know, they typically buy and hold long. She's like, oh no, this guy's like you, but he flips multifamily. And I'm like, oh my God. And she's like, you should really learn about it. And I was like, oh, maybe I will. I never really thought about it that way before. She's like, there's actually a free course a week from now in Jacksonville if you're still in town. And I was like, what the fuck?
Yeah,
how do you know about this? This is a 60-year-old woman, runs property management, is telling me as a single family home flipper who's played, unless maybe I came through and she's like trying to test my bullshit or something, which very possibly can, but she's like, yeah, this guy flips multifamily properties. And I'm like, oh my God. Now, granted, she could be using different vernacular because I say I'm a flipper. And, when I talk to flippers, a lot of times they don't understand what I'm saying. So I'll change. Like I would never use ARV when we talk about a multifamily, but I might if I'm talking to a flipper so they understand. So probably some of that bled through, but I was like, this is unbelievable. Yeah. I was like, it's spread so far.
This is 2006.
Now in the property management.
2000. I mean, I remember hairdressers flipping houses. Yeah. It is now multifamily, bigger is better, has gotten to hairdressers. I am scared.
Yeah. No, people, I tell people all the time, they're like, oh, flipping multifamily, or now they want to flip contracts on multifamily. I'm like, explain that to me. There's a due diligence process and financing contingencies. Like, or finance. You can't just pick up a multifamily deal for $10 million and go call your neighbor and flip it for $1 million. Like that's just, I mean, you might be able to do that, and there might be an asshole on the other side, but that's when you know something's gone a little something.
Well, that's the off-market deal in Orlando. We got an off-market deal in Orlando. $12
million.
$12 million, but no, it was 16, but he would take it for 13 or something like that. And lo and behold, we find out they would take 12.
Yeah.
And I'm talking back and forth, and he keeps, instead of using the word seller, he keeps using the word buyer. And I'm like, why are you talking about me? I'm the buyer. And I'm like, I didn't really push him on it because it was like, I'd only spoken to him once prior. So it's a new relationship, but Orlando, interesting. It was a vacant property. Yeah. I was like, okay, this could be an interesting project. And then eventually I get to the end. I was like, why do you keep saying buyer? I was like, I'm the buyer. What do you like? Do you mean the seller? He's like, no, the buyer. I was like, do you mean that there is a buyer under contract who's trying to sell this? And he was like, oh yeah. I was like, dude, I don't care. I'm not interested.
Oh my God.
I was like, stop. I was like, I don't care. So, but that's the stuff that's out there. But we've gone very negative. Can you talk about operating properties through that time period a little bit? Because it was interesting to me because it wasn't doomsday.
No, so there's, I think now I know where you wanted me to go. So
I wanted everything. So I'm happy.
Yeah, okay, good.
Went, but I wanted both sides of it. So
one of the things that is a half truth in multifamily investing, and again, this is from a guy who's never owned anything bigger than 18. I own several of them, but they're 18, right? So I have on-site and all that nonsense. But there's often this saying that properties, when the recession comes, that you're going to have record occupancy, right? You've heard that out there in the world, that my apartments will be okay because when the recession comes, my occupancy will go up.
Mm-hmm.
Well, kind of. So I invested through that. I had almost 100 units in apartment buildings at that time. And it is true, I had record occupancy. However, I lost money because what happens is we're in America and people live paycheck to paycheck. So I had 30% of my units go vacant turn inside a 90-day window because the wife or the husband or both lost their jobs. And most of them left on their own. They said, sorry, we can't pay, here's the keys. We're out, right? They moved in with mom and dad or house hacked or whatever they did. Some I had to evict because they just wanted to fight and stay for free for a while. But when you have to turn 30% of your units, which is roughly 30 doors inside of a 90-day window, you'll fill them up quick because people will trade down. But as an owner of a property, I lost money because a turn is expensive. That's what people don't get is a unit turn is what kills a landlord, right? And you can plan for a certain percentage, 5, 8, 10, whatever you want. But if that triples because the economy smacks you in the ass, you're going to lose money. Even if I lost money and I had record occupancy, and people just don't get that. And I'm very nervous if unemployment doubles, what's going to happen to all of these investors who are so skinny? They're planning for 5% turns. And if it goes to 9%, they're in trouble. Mm-hmm. Well, shit, I lived through 30% and it's not fun.
But that's the truth. It costs money to turn an apartment, and people want to run things as lean as possible. But if tenants leave, they're typically not in bad condition, but you either release it to a shitty tenant in shitty condition, or you have to put money in to fix it. And that's where, we had a conversation earlier today about 1960s and 70s built deals and 2000 built deals. And I said, we've done very well in 60s and 70s built product, but I don't want to own 60s and 70s built product for 15, 20 years because it's 60-year-old product. You're going to have problems with it. So
you're right.
Yeah, you might be 100% occupied, but your turns are they kill you. Now, if your business plan is to go in there and turn everything out of the box, totally different. But at some point, you want to occupy it. You want people living there that are paying. If they're paying and living there, you win. If they stop paying or it's vacant, you lose. And that's where you went through it. 100% occupancy, great, but you're still fighting, right? You got through it, but you gotta budget for it. Let's call it, right. But yes, in a recession, the $1 million, my apartment will be okay. You may be okay,
Maybe.
Yeah, you may not be. So you just got to be aware of it. But I think that's important information for people to hear.
Yeah, and it goes back to you talking about being well capitalized as well. All these new sponsors that are not well capitalized. If now your turn cost or your occupancy is lower, or your break, whatever it is, your income is, your NOI is not going to be high or negative.
Correct.
And you've got mortgage payments to make. Where the fuck is that money coming from? So are you going to do a capital call? Are you going to take out a loan? Are you going to steal from another property that doesn't have that issue? Or are you going to take money out of your pocket? A lot of people couldn't do it. I know if I was doing it on my own for the last 3 years, I would not have the capital to lend money to a property that was missing on a $50,000 mortgage payment every month.
Yeah.
That's fucking not happening.
It would hurt.
Yeah.
And
it wouldn't hurt. It wouldn't happen. I'd have to call the investors and say, hey, guys, I don't have the money. I can't loan it. We got a mortgage payment coming up. What are we doing?
And
look, it's the right thing to do. You have to do it. If you're a sponsor, if you're an investor and you go with a sponsor that's newer, you have to understand that they are probably not well capitalized unless they have a backer. You have to understand that if it goes sideways, they may ask you for more money. Obviously, you have no obligation to do so unless it's in your contracts. But I mean, so what are they going to do? They're going to go into your account and pull money out.
Yeah, you can't make someone give you money. Yeah. Well, you can. It's just so illegal.
Right.
There's ways to do it, but that's you don't want to.
Still, like you have to understand that. So now it's again, okay, what type of group are you picking, and what type of debt are they having? Like that's the other thing I know we spoke about. We won't go into it too much because we've been going for a while now. But comes back to the leverage and the debt and everything. And deals aren't created the same by the leverage they have and the capital they're putting into it, but. That's a whole other.
Yeah, we talked earlier about lending potentially leading this. I actually think, again, as an operator of apartments, not nearly at the scale of some of these syndicators, and I don't pretend to be, but I can tell you when unemployment gets to 6%, most or many, probably not most, but many of them are going to be in a position where life sucks. They're not going to be having any fun.
What's unemployment now? 3?
3.5.
Yeah, it's under 4.
Yeah, 3.5. It's been a record since 1969. 3.5.
Records are meant to be broken in both ways.
Both ways. Yeah. Could it get better? Sure. Is it likely? Not really.
Yeah, you got to be real. But no, that's very because I say all the time. It's just like our national debt is so high. If they raised interest rates 2 points, we'd go bankrupt. So there's so many factors playing into the market. Could run for another 5 years. Could, but it takes one trigger for unemployment to jump up to 6 and then to 8. And what happens then? The interest rates go down? Maybe. The interest rates go up? Maybe. But it doesn't matter. The operators will not be able to fund their business. I don't care if interest rates go to 0. It won't be about the debt. They won't be able to service turning their units and getting new people in. It just will break. I've seen some of these offerings. I'm like, you're freaking crazy. Yep. There's no doubt about it because when unemployment goes up, that's the ultimate kill-all in apartments because bingo. Both people are going to lose their jobs or one or the other, but you could do the other thing. You could just lower rents 30%, but then you're still not going to cover your mortgage. It doesn't. Yeah. You might have people living there and you might be breaking even, and that may be a lever that you have to pull to keep occupancy, but if they can't afford it, they can't afford it. And that's quicker to come. Like you said, even if they were giving away money for free, it doesn't necessarily matter because they can't afford it. And they're not going to be able to get the money to pay for it. Because they got to go to another job. So you got to find markets that are diverse, markets that have drivers, markets that are in good economic cycles. There's a lot of things that go into it. But you're right. I mean, unemployment's a killer. And you do not want to see unemployment trends going, 1-20 towns, right? That's the ultimate kill all. Yeah. If they go out of business, then you're fucked. But you want diversification. So if there is a sector that gets beat up, you have a backstop. And that's very important.
For sure.
Well said.
Awesome. I think we'll wrap it up there. I think that's a great place. Mike, thanks for coming on. You want to tell people where they can learn more about you or get in touch with you?
Yeah. So again, Michael Zuber. I did write a book. It's called One Rental at a Time. You see it over my shoulder. Paperback. Woo! Published author. My mom is so proud. Go get it on Amazon. I do produce daily content, which Chris, you were a part of that on a YouTube channel. It's called One Rental at a Time. So go there. Best place is One Rental at a Time, free stuff, daily videos. I'm just having fun now. So it's pretty awesome.
Awesome. Perfect. Well, thank you so much again for coming on. I think this was great. We spoke way longer than I thought, and I think people are going to get a ton out of it. So thank you very much.
Thank you, Chris. Thank you, John.
It was awesome.